Hello everyone, welcome back to another video. So today we're going to be talking about the different types of financial instruments and securities. So until right now, whenever we've been talking about the stock market or any type of financial market, we've been saying that when you transact something on that market, you transact a stock. Well, that's not entirely true. On any type of financial market, what you're really transacting is a financial instrument. A financial instrument is simply an asset or contract that can be bought and sold on the open market. It's an asset with a monetary value and it can be transacted. And there are different types of financial instruments that are sold and bought on the market. And the four types that we're going to be talking about today are individual stocks, mutual funds, exchange traded funds or ETFs, along and finally index funds. So basically, let's get started. So individual stocks. So individual stocks are a type of financial instrument. A financial instrument simply is a general umbrella term that refers to some kind of asset that can be transacted and that has a monetary value. So an individual stock is an asset. It's simply a part of a company and you can transact it on the open market and it has a value, which is simply the demand associated with that stock depending on the company's performance. So this is all common knowledge at this point. We've already talked about this, but yeah, there are different types of individual stocks. There's the penny stock and there's the blue chip stock. So the penny stock and the blue chip stock have two key differences in terms of price and in terms of risk. So let's start off with the penny stock. So it refers to a stock that trades below $5 a share. So the value of the stock is less than $5. And the key thing to note about penny stocks is that most penny stocks are more risky because there's less oversight and there's less regulation because they tend to trade over the counter as opposed to trading on an exchange. So what does that mean? Remember how I said that stock exchanges are simply a place where buyers and sellers can congregate so that they can transact the different stocks or financial instruments that they wish to transact. In order for a financial instrument to be verified and transacted on a particular stock exchange, like the New York Stock Exchange or the London Stock Exchange, for example, the owners of the exchange, the people who run the exchange, they have to make sure that the instrument is actually viable and that it's something credible and that it's authentic. So they're going to be vetting the company and making sure that the books are clean, everything is clean, such that the company has some authenticity associated with it. However, when it comes to penny stocks that trade over the counter, uh, this level of oversight is not present. So basically, just about anyone can create a stock and trade it over the counter. As a result, it's possible that there are sham corporations or shell companies or just fraudulent companies that are trading their shares on the OTC as opposed to a particular exchange. So there's less oversight regarding penny stocks. So even though they're cheaper, they can be more risky because since there's less oversight, it's possible that there's manipulation or stock fraud that's going on. In contrast, blue chip stocks tend to be the stocks of larger companies that have proven excellence, reputation, and good track records. So, in order for a blue chip stocks, they usually trade on exchanges. So, for example, on the New York Stock Exchange or the London Stock Exchange. So, they actually go through this process of being vetted and being made sure that these stocks are actually credible. So when you buy a blue chip stock, you know that you're not buying a fraudulent company, something that's not always true with the penny stock. In addition, blue chip stocks tend to be a bit more expensive. For example, the stocks of Amazon, Berkshire Hathaway, Google, Coca-Cola, they're much more expensive than $5 a share. In fact, Berkshire Hathaway Class A shares are almost $300,000 a share. So they're much more expensive, but at the same time, when you're buying a blue chip stock, you know that you're buying into a large, stable corporation that has already been vetted by the exchange. So you're not buying into a fraudulent corporation. So that's the key difference between penny stocks and blue chip stocks. Blue chip stocks are larger, refer to larger companies, and they tend to be more expensive. But at the same time, they tend to be a little safer because they've already been vetted and they're authentic. On the contrary, penny stocks refer to cheaper stocks that are less than $5 a share. They don't always trade on a legitimate stock exchange. Instead, they trade over the counter, which is why there's less oversight and there's more risk regarding their financials and their operations. Now that The key thing to note is that I did say blue chip stocks tend to be safer, but that doesn't mean that blue chip stocks will always yield you profits. Just like any other stock, both penny stocks and blue chip stocks will trade up and down depending on the company's performance. So it's important to know your reasons before getting into any stock, penny or blue chip. But these are just the two main differences between the two. So as I've said before, this is just recapping everything I said about penny stocks. Penny stocks are not traded on major stock exchanges. They trade over the counter or OTC. There's less regulation and oversight over the finances and company status, and as a result, there's increased risk. So now I want to talk about mutual funds. So mutual funds are another type of financial instrument. Like I said before, financial instrument is an umbrella term referring to any asset that can be transacted and has a monetary value associated with it. So a mutual fund refers to a pool or a portfolio of investments. So how exactly does all this work? So we basically have companies that have something called mutual funds. And what goes on in these mutual funds is that the company collects a pool of money from many different investors. And professional money managers that constantly study the market and are constantly active actually manage all the money that's been gathered from the investors. And they basically invest the money into a variety of different assets or financial instruments. They can invest the money into government bonds, they can invest the money into stocks, they can invest the money elsewhere. Basically, they invest the money in many different ways and try to get a profitable return. So when you buy a mutual fund, you're basically giving some of your money to this portfolio or this pool of money that's been collected from many different investors. And when you buy into the fund and the fund appreciates or depreciates, your position in the mutual fund will appreciate and depreciate as a result. So, for example, one of the most well-known funds is the Vanguard Mutual Fund. So, if you were to buy, let's say, 10 shares of the Vanguard Mutual Fund at the price $300 per share, you'd essentially be contributing $3,000 to the Vanguard Mutual Fund. The Vanguard Mutual Fund has its respective investments, and as a result, the price of the investments would fluctuate, which means that the shares of the mutual fund that you bought or your stake in the mutual fund would also fluctuate as a result. So a mutual fund is not the same as a stock because a mutual fund is not a part of a company. It's a part of a portfolio or it's a part of a group investment that's being monitored and transacted by active money managers. And of course, mutual funds also have their own fees associated with them because these money managers and these corporations that are running these mutual funds need to turn profit. There's usually profit and asset fees. So let's say that you contributed some money and the fund created a profit, then you wouldn't get all the profit back. You'd have to pay some type of fees, and these fees depend on the different funds that you're investing in. But that's just another thing to note. So a mutual fund is just a financial instrument that refers to a collection or a pool of money that has been invested into a portfolio that is managed by active money managers. So this is just an infographic as to the process regarding mutual funds. So we got investors who pool in their money. Then we have a fund manager who decides to invest the money however he or she sees fit. So he or she invests the money into different securities and hopefully they generate some profit, which is then processed or passed back to the investors. And when it's passed back, there are some fees that are deducted from the profit and from the assets, such that the mutual fund corporation and the fund managers and everyone associated with the entire fund can profit. So now I want to talk about index funds and ETFs. So what is an index fund? An index fund tracks a particular index by matching the components of an index. So what is a stock index? A stock index usually refers to a basket of different securities. So some of the most well-known stock indexes are the S&P 500 and the Dow Jones. So what these indexes really are is that they're a collection of different companies or a collection of different securities, and and the value of the index will fluctuate depending on the value of the underlying securities. And for example, the S&P 500, the name is derived from the fact that the S&P 500 is an index of 500 companies that stem from a variety of different fields and different sectors. So we have companies that are in tech, that are in agriculture, in energy, so on and so forth. So as a result, it's basically tracking the entire economy, so to speak. In contrast, the Dow Jones 30, it's an index of 30 stocks, and these 30 stocks are said to be the most powerful or the biggest corporations on the market. So it's basically tracking the movement of the biggest corporations. So that's what an index is. It's like a basket of securities in which the value of the index fluctuates based on the underlying securities that constitute that index. And indexes are useful to gauge stuff like the general market, for example, when it comes to the S&P, because the S&P has companies from every sector in the economy. And on the contrary, we can also have the Dow Jones, which is a good measure of how the top companies are performing, because the Dow 30 constitutes of the top 30 companies. So an index fund basically tracks a particular index by mimicking their movement. So for example, the S&P 500 stock index tracks the movements of the 500 stocks, and the S&P 500 index fund mimics the S&P 500 index. So these are passively managed, so there's no money manager. They're basically just tracking the they're basically just tracking the movement of the securities that constitute the index, and these are traded daily. So, yeah. Now let's talk about exchange traded funds or ETFs. So ETFs are very similar to index funds. So it's basically a collection of financial securities, usually stocks. So what this means, it's like a little bundle of stocks, and ETFs tend to be a little bit more diverse. So whereas index funds only track indexes, ETFs can also track sectors or more specific things. For example, let's say I wanted to buy a tech ETF. A very well-known tech ETF is called QQQ. That's the stock ticker's name, or the ETF ticker's name. So what this ETF is really doing is that it's a collection of different tech stocks. So for example, there's Apple, Amazon, Google, Facebook, Netflix. Those constitute the FANG stocks, or the five biggest tech stocks. And there's different stocks in there as well from the tech sector. So there's a whole bunch of tech stocks that are packaged together into one asset that we call an ETF. And if you buy this ETF, the value of the ETF changes depending on the value of the different tech stocks that make up the ETF. So ETFs can be profitable or useful in the sense that, let's say you just thought an entire sector is going to go up. So instead of buying every company within, for example, say the tech sector, you can just buy a tech ETF because you think that tech in general is going to do good. So that's basically how ETFs work. And the main difference between ETFs and index funds is the way that they're traded on the market. So when I say that index funds are traded daily, that means that the price of the index fund won't fluctuate every second throughout the day. Basically, when whenever you buy it, it's going to be bought at the end of the day's price. So basically, the index fund will see how all the different stocks or all the different securities constituting an index fluctuate throughout the day, and at the close, whatever that price is, the index fund will represent that price as well. On the contrary, exchange traded funds like stocks can be traded throughout the day, which means that their price fluctuates throughout the day. So that's the key difference between them. All right. So in the next section, we'll be going on to financial statements. But just to sum everything up, we have different types of financial instruments, which is simply an umbrella term that refers to assets that have a monetary value and can be transacted on the open stock market. So there are different types of financial instruments. We talked about four of the main ones today. We talked about individual stocks, where we broke down the differences between penny and blue chip stocks. We also talked about ETFs, index fund, and mutual funds. And there are many other types of financial instruments as well. For example, some of you may have heard of stock options or option contracts. You may have heard of futures or derivative contracts. So these are other types of financial instruments. They are a little bit more complicated. So for the sake of this course, we're not going to be going into them. But just know that there are many types of financial instruments, and we just talked about a few today. So I hope that this video was helpful and you guys learned a lot. Thank you.